Oh, I have got some pretty heavy duty stuff for you today. I hope that you're ready to really dig in on this Sunday afternoon. So I am not sure how I've missed this account on X, but Roland Bircher, who goes as at Pilolly, Piloli. I'm not sure how you want to pronounce that. Anyway, he says that the Tesla Model Y was the 2023 best-selling BEV in nearly every country where it's available. And so he's got some rankings here. These are the sales rankings of Model Y of all cars, not just BEVs, by country. So in other words, this is every car, and this is the place that Tesla takes. So first of all, in first place, without any question, is Denmark, up 11 places from 2022. Iceland is number one. In Norway, number one. Sweden, the Netherlands actually jumped 18 points to become number one. Switzerland is number one. And of course, China is number one. In second place, we have Finland, which is up 11 points. He's showing fifth place. He's showing the United States having gone up 4 positions to get to fifth place. I kind of thought that by the end of the year that Tesla was number one, but maybe that wasn't for the year. I can't remember. United Kingdom also showing in fifth place, and Thailand showing in fifth place. And we got Australia in sixth place. It's only been in Australia for about 2 years, I think. Germany up 1 place to eighth place. France jumping 29 places to get to eighth place. Then we've got Ireland jumping 131 places. I guess they just started selling in Ireland to go to 11th place, and then Spain at 38th place. Again, must have just started or barely started there, because that's jumping 60 positions to get to 38th place. So I've released this. Oh, this is Randy Kirk. And if you have not been watching my series on predictions, I just think it's really fun. Maybe I'm completely wrong. But if you haven't been watching the series on predictions, there are now 3 of them. So that would be 30 out of 50 predictions that I've made about what's going to happen with Tesla in 2024. And there'll be 2 more of these. One will be out tomorrow morning, and I don't really know when the 5th one will come out. I don't really have a slot for it yet. Might be as late as Thursday of next week for that 5th one to finally come out. Remember that these are coming out much earlier on Patreon. And so you might want to join Patreon so that you can get earlier access to these and other information that I sometimes put up there. But, the real reason to join Patreon is just to support the channel, because you're getting value. All right. And then hit like, hit subscribe, all the regular stuff. And of course, notify so that you're notified. We got Larry Goldberg or Brian White tomorrow around the noon hour. We've got the regular on Monday night. We will be doing Tuesday morning, which will be because of the shortened week on the stock market. On Monday night, we will talk about what's going to be happening, earnings reports, federal reports, all kinds of stuff that's coming up next week. And that'll be up on Monday night instead of where normally it's on Sunday night. All right, let's get into the, Cybertruck. Nice order for another 4 of these today. People are continuing to order. And this was a reorder of somebody who has ordered in the past, I think twice, if I remember correctly. Anyway, get those orders in for Cybertruck. Now let's go on here. We have got, I did a series of polls, okay? By the way, I've got a really comprehensive thing on the economy coming up. Don't go away, all right? If you're not interested in the polls that I'm taking, fine, but you do want to stick around for this comprehensive report. So I ran a poll. The first question, 3 questions. Do you believe that Optimus is currently capable of doing useful work similar to bots seen on videos recently by Figure and others? The yeses right now are getting 57.4%. So well over half of the folks think that Tesla is absolutely as capable, more capable than others that are out there now. No, 27.8% think that somebody, maybe Figure, maybe Atlas, maybe some others, are doing a better job right now than Tesla in terms of the capabilities of doing useful tasks, and then a bunch of don't knows or show results. All right, now my second question is, do you think Tesla has Optimus bots training right now in simulated auto production jobs in preparation for working in the factory? Now, this was higher on the yeses. This was almost two-thirds, 63.9%. Only 30% thought no, they're not already working on some kind of simulated production line. And no guess was only 5%. So everybody had a real opinion on this one. That was interesting. And then my third question was compared to a new automobile production ramp. So if you got a new automobile production ramp, we know we're thinking that the Cybertruck will maybe get to 75 to 80,000 the first year. The question is, do you think Optimus will be a slower, the same, or faster production ramp than an automobile? And we had 16% thinking it would be slower. We had 4.2 saying it would be the same, 41% saying faster, and 37% saying much faster. So almost 80% saying that the production ramp on a bot will be faster or much faster than a Cybertruck. So I thought those were really, really super interesting reports. So now, as I mentioned earlier, we're going to turn to the economy next. We're going to take a look at some of there's an article that takes a solid look at the metrics, which I think you're going to agree with me are going to be critical coming up this year. So this is a report by Sam Rowe, and it's in Yahoo Finance. He starts off by saying the labor market continues to add jobs. According to the BLS Employment Situation Report released Friday, U.S. employers added 260,000 jobs in December. The pace of job growth has been getting cooler, 36 straight months of gains. So their labor remains in demand. However, take a look at the curve. So what I want you to look at is the curve. So the trend is definitely down in terms of adding employees. Now, does that mean the trend continues? No, absolutely not. But it gives you some idea of how dramatically the amount of labor that's being added each month has been trending down. This is January 2021 all the way to the current last 6 months. All right, now let's go to second. Employers added a whopping 2.7 million jobs in 2023. Total payroll employment is at a record 157.2 million jobs. So again, you can see the trend here. You can see we had the big drop off and then the immediate recovery as it's gone way, way up here to the highest number of folks that have ever been employed. Now we've got the unemployment rate. That is the number of workers who identify as unemployed as a percentage of the civilian labor force. That stood at 3.7% during the month. While it's above the cycle low of 3.4, it continues to hover near 50-year lows. So now you can see this in 1970. You can see some of these trends. You can remember some of these dates in terms of the 1990. You know what happened then. That was the George Bush recession. Then you've got the 2000. You have the recession from the dot-com bust. Then, of course, you've got another recession, 2008, the big one in 2020, et cetera. So now you've got the right down here, you can see we're at very low numbers, but what's going to happen next? And most people, well, okay, so the idea here is that we might be looking at a situation where we're going back towards 4%, 4.1, 4.2, as more labor comes into the labor force, and there isn't enough jobs, as noted above, because you're having fewer and fewer added to the labor force. The unemployment rate could start to move up towards 4.1, 4.2. Who knows? Maybe even higher. That would be that would look recessionary. Wage growth is cooling. Average hourly earnings rose by 0.44 month over month in December, up slightly from the 0.35 pace in November on a year-over-year basis, but the metric is up 4.1, a rate that has been cooling but remains elevated. So you can see the rates coming down fairly fast. Of course, the Fed would like to see it at 3% per year, and we seem probably to be heading toward that. Job switchers still get better pay, according to ADP, which tracks private payrolls and employs a different methodology. For those who change jobs, they're making 8% more than a year ago. Those who stayed at their job, 5.4, and ADP is showing higher numbers than the federal government's numbers in terms of wage growth. So once again, you can see how these, however, are coming to be narrower. These were folks who were leaving their jobs in order to get higher pay. These are people that stayed and got higher pay. And you can see the two are now coming closer together. Then we have job openings ticking down. According to the BLS job openings, the JOLT, employers had 8.7 million job openings in November. That's elevated above pre-pandemic levels, but down from March 22 high. All right, now look at this one. You can see this is how many jobs are open, how many jobs are available. This is a low, back in 2014, you had 4 million. You had 6 million here as the economy was perking up. You've got all the way up to 8 million here. Then you had the pandemic. It went up to almost 13 million. Okay, so this is crazy, completely out of bounds compared to normal. And now you end up having it starting to come down fairly significantly. The trend seems to be clear. Now it says during that period, there were 6.2 million unemployed people, meaning there was a 1.5 job opening per unemployed person. And this is one of the most obvious signs of excess demand for labor. Duh. If you've got almost two job openings for every one person that's looking, that would say demand is extremely high. And as it gets closer to one, well, now look at this. Go back to your 2014, you had 0.4 jobs available for every person that was looking. You got up to 1 for 1 in 2017. So there was one job for every person that was looking. You can see that this is already getting to be fairly strong here, drops off, of course, and then picks right back up here to the place where it was over 2 jobs for every person looking. Now coming back down to what was pre-pandemic, my guess is we continue down where we get to maybe 1 for 1 if the economy stays okay. Could drop under 1 for 1 if the economy gets soft. Layoffs remain depressed. Hiring remains firm. Employers laid off 1.53 million in November. While challenging for all of those affected, this figure represents just 1% of total employment, and it's continuing to trend below pre-pandemic levels, but not much. This is pretty close, as you can see, to pre-pandemic levels. All right. Now we go into hiring activity continues to be much higher than layoff activity. During the months, employers have added 5.47 million people, and you can see the comparison here on this chart going through the end. I don't think, maybe the end of 2023. So this is also trending down. Same thing. All right. Unemployment claims are falling. Initial claims down to 202,000. Been around this area, though, right around 200,000 for quite a while, but it was, popping up, but now it's heading down again. Hard to say which way this is going to go, but it could be fairly impactful if that number starts to pop up more. What have I done here? I've got myself into trouble. I'm so sorry. So kind of the conclusion here is that corporations are speaking less about labor shortages. From Bloomberg's Michael McDonough. Labor shortages seem to be receding into the rearview mirror, as evidenced by related mentions on S&P 500 earnings calls. Meanwhile, conversations around job cuts are prominent, though they haven't reached the heights observed last spring. Now then we go on to earned interest. They say consumers have been earning interest. From Wall Street Journal's Gunjan Banerjee, Americans generated about 300 billion in interest income from money markets funds in 2023, according to estimates from Crane data. Now, this one is very hard to see. I don't know why the bars are so light, and there's nothing I could do to solve that, but we can see that your normal amounts of interest here, the best I can tell, sometimes down almost to nothing. Now coming back up, going way down again to nothing, and now going up crazy. Well, that's probably not going to continue next year. So that could be an impact that nobody's really paying attention to. Card data suggests consumer spending is holding up. From Bank of America, total card spending per household was up 1% year over year in the week ending December 30th. And then according to Bank of America aggregated credit card and debit card data, spending on holiday items fell 1.3% year over year in the week ending December 30th. However, in the total between Thanksgiving and the end of the year, it was up 0.3%, which is not a lot. Not sure whether that included, nothing in the information here says whether that is inflation adjusted or not. But again, we can see that the credit card spending has been fairly flat here, not like back here, but fairly flat except for this period right here. So then vehicle sales from Wards, December U.S. light vehicle sales hit 5-month high. The entire of 2023 totals the 4-year best, 15.5 million. Labor-related plant shutdown, of course, affected that. We can see that right here. But then combined sales of the vehicles impacted by the shutdowns fell 15% year over year. If those vehicles had matched year-ago results, sales would have totaled 15.9. 15.9 is still a very low number. So how do we look at this kind of very low period? You can see it got almost up to normal here, fell off, of course, came back almost to normal, fell off again. So we've had very low auto sales rates in the United States. And will those rates recover this coming year because the fleet is getting old, or are we in a downtrend where we will continue to see problems? Now, interest rates dropping could help the auto industry, and that could help us from going into a recession, along with what I've been talking about for a while, is that housing could be the number one thing that keeps us from going into a recession. Gas prices continue to fall. The national average for a gallon of gas dipped slightly by 3 cents last week to 3.09. Lower demand, fewer people fueling up for holiday road traffic. According to new data from the Energy Information EIA, gas demand nosedived from 9.17 to 7.95 million barrels last week. Meanwhile, total domestic gasoline stocks increased substantially. So we've got very high inventories. We've got lowering demand. We got high inventories of oil at the same time, high inventories of natural gas. So everything right now is extremely heavy duty in the inventory department when it comes to energy resources. And so that would tend to tell us that in 2024, we're going to continue to see energy prices dropping, which will be good, of course, for the economy and for inflation, and therefore for the potential for interest rates to drop. So you can see gasoline prices coming down substantially. And the other line, those are different years. So you see the 2024, just starting 2023 was the dark blue line, went up here and now down almost to the lowest over the 3 years. All right, so then mortgage rates tick up. According to Freddie Mac, the average 30-year fixed rate went to 6.62 from 6.61. That is a nothing burger. That is not the headline here. The headline is it's down to 6.61 from 8% just about 6 weeks ago. Between late October and mid-December, the 30-year fixed rate mortgage plummets, there you go, way more than a percentage point. However, even moving sideways is slightly up. Welcome news, of course, mortgage rates being up, potential buyers still dealing with the dual challenges of low inventory, which will continue, and high prices. And that is surprisingly, the high prices are continuing into November, at least. We'll see what happens in the December stats when they come out maybe next week, following week, I think. So again, you can see how the mortgage rates have come down dramatically. We are now back into normal. 6%, 6.5% is normal over 100 years. That has been the average. Supply chain pressures loosened. The New York Fed's Global Supply Chain Pressure Index, a composite of various supply chain indicators, ticked lower in December and remains below levels even seen before the pandemic. That's way down from the December 2021 supply chain crisis high. And you can see at one point it dropped below zero in terms of the pressure. And now it's back up to just about normal. And that's where you want to see it. You want to see normal supply chain activity. And that's where we are. Now, the Red Sea thing is creating some supply chain problems. But as of now, I don't see the Red Sea affecting American supply chain issues to any great extent. Okay, then we got the services survey signals slowing growth in services. Now, this is what the Fed wants to see. The ISM's December services PMI reflected growth in the sector, but at a decelerating rate. And you can see how dramatic that deceleration is, almost back down to the 50% break-even line. The survey's employment sub-index reflected the sharpest contraction in hiring in the services industry since May of 2020. Once again, the graph shows it beautifully. Manufacturing survey continues to signal contraction. The S&P's global December manufacturing PMI signaled deterioration in the sector. From this report, output fell at the fastest rate for 6 months as the recent order book decline intensified. Manufacturing will therefore likely have acted as a drag on the economy in the fourth quarter. However, I just saw a report the other day suggesting, that the economists that have been polled think that the GDP is going to be up 4.8% for the fourth quarter. So that would be a surprise to me, but maybe that's true. So you can see again, manufacturing had done okay here, but has been just collapsing to well below the trend line, for the last couple of decades. Nothing, of course, like the problem. This is the what do you call it? What do they call it? The big recession. I forgot the name they gave it. Okay. So then we've got ISM's December manufacturing PMI improved slightly, but no, 14 consecutive months of contraction. So that's what we got with manufacturing. Now there's a point at which inventories are going to finally cause manufacturing to turn around. It's worth remembering that soft data like the PMI surveys don't necessarily reflect what's actually going on in the economy, they said. Now, this is the big one. This is a surprise. No, not a total surprise, but surprise to a certain extent. Construction spending is rising and continuing to rise, rose 0.4% in the latest period. So you can see a continuation of this construction. Public is down here. You can see it is rising. Private is also rising. Then you get the total. So very strong on construction spending. And again, with housing, residential housing really beginning to look like it's going to take off in 2024, construction numbers could continue quite well. Business investment picks up. Orders for non-defense capital goods, excluding aircraft, which is called the core CapEx or business investment, rose 0.8% in the latest period to a record $73.97 billion. So a lot of investment. See, the investment dropped off dramatically during this time period here where people were scrambling just to stay alive, just to get product in the door, just to find employees to manufacture or service or whatever. So now, though, you're starting to see people spending money on capital goods. Then you got the near-term GDP growth. The Atlanta Fed's GDP Now model sees real GDP growth climbing at the 2.5% rate in quarter four. But as I just mentioned, I saw that the survey of economists has it way higher. So it'll be interesting to see who's right on that. But again, we can look at the Atlanta Fed GDP Now estimate right here going into next year, expecting it to stay above 2%, except for a slight dip here. And then the blue chip consensus only goes through now, and it is below the Fed. That's the blue chip consensus. But as I said, we've also got this other list of the survey results. So what does all that mean? I think that's all that we have here for this guy. What that means is I continue to believe that there's a 50% chance. So does that sound like I'm waffling? I mean, Randy, how do you feel? Well, I feel, it's really a hard call right now. Whereas a month and a half ago, I would have said no chance of recession in 2024. What has really begun to cause me to shift my thinking was, number one, everybody said no recession. That's always a bad sign. I know that seems like an odd way to do it, but the data was suggesting either a very flat economy in 2024 or maybe, flat and then rising toward the end. Everybody had a different opinion, but everybody just across the board, no recession. And you know what happened last year? Everybody said no recession. Everybody last year said, oh yeah, absolutely going to have a recession. And I'm like, there's no recession, not a chance, not with these kind of employment numbers and the employment shortages. And all the money on the sidelines, massive amounts of money on the sidelines, consumers with money in their checking accounts, money in their savings accounts, no credit. Their credit was at all-time positives in terms of not borrowing. People owning their own homes outright. 40% of all Americans own, 40% of all people who have a home, a residential home, own it outright. I couldn't see where the recession was going to come from. Now, this year, I can see where it could come from. Primarily, it's going to come from trying to beat the third quarter number. Yes, labor is starting to trend down. Yes, manufacturing is still down. Yes, services are starting to trend down. All of that would be kind of okay. That's kind of a flat year. All of those things could be contained within a flat year. But what we had was the government spending massive amounts of money in the third quarter. Maybe that continued into the fourth. I'm not sure. There's not enough data yet. And you're not going to have those increases this year. So how are you going to get above third quarter numbers from last year? And at what point does the kind of generic slowdown from just normal business activity finally kind of settling down, and maybe it needs a little breather compared to an actual recession? So we'll see. And maybe if it starts in the third quarter, we won't even know before the election that we have a recession, because it'll be the fourth quarter reporting in the new year before we know whether we're in a recession or not. Now, there's another article out that I had a look at the other day. I think this was Bank of America, but don't quote me on that, saying, no, it will feel like a recession, even if it's not, because it's going to start impacting across the board rather than just in this industry or that industry, the rolling recession that Larry Goldberg has talked about so often on our show. We've definitely had this rolling recession. There's no doubt about that. I know industries that are really hurting right now, and I'm sure you do too. Now they're saying, okay, some of those industries might start to pick up, let's say durable goods, for instance, where other industries like potentially services, manufacturing, who knows about auto? Maybe there won't be as much construction, for instance, of rental dwellings next year, multifamily dwellings. That was doing very well last year, but now rents are coming down. So maybe there's a little bit of a cooling off in that area. So anyway, I'm at 50-50 right now. I am still gathering data. I would like to be able to make a more definite pronouncement, even though who knows, but even if I get all the data in, I could as easily be wrong as anybody. Because, if you get 5 economists, and I'm not one, into a room and you want an opinion, you will get 9 opinions. So having said that, please hit like, hit subscribe, hit notify. Want to see Larry Goldberg? Probably tomorrow it's going to be Larry Goldberg. We're not sure. If not, it'll be Brian White. Brian White will definitely be on either Monday and Tuesday or Tuesday and Wednesday. You're going to want to see the 4th edition of my predictions with another 10, a total of that'll be 40 out of the 50. I'm going to put up a card right here, right now. I'm going to put up a card where you can go back and see the first 3 of those predictions sets that I've already done, and the 4th one will be tomorrow morning. And then, of course, you want to buy these and you want to join Patreon. And I think that's it for tonight. It's been great talking to you.